As of the market close on Wednesday, November 26, 2025, just ahead of the Thanksgiving holiday, Robinhood Markets, Inc., trading under the ticker symbol HOOD on the Nasdaq, finished the session at $128.20 per share. The stock staged a massive intraday rally, surging by $12.63, or 10.93%, in a single trading session, cementing its position as one of the most aggressive movers in the current financial landscape. While the markets are currently closed for the holiday, this closing figure represents the most up-to-date valuation available, reflecting a frenzy of institutional and retail buying pressure that pushed the stock near its intraday high of $128.90. This price action is not just a simple fluctuation, it represents a fundamental repricing of the company's future cash flows and strategic value. The expectation for Robinhood has long been anchored in its past identity, a chaotic, gamified interface that served as the playground for the 2021 meme stock craze, a place where novice traders swapped shares of GameStop or AMC with little regard for fundamentals. The market anticipated that, as interest rates rose and the stimulus checks dried up, Robinhood would fade into obscurity, crushed by the weight of serious competitors like Fidelity and Charles Schwab. That was the narrative. The reality, however, has completely upended that assumption. Robinhood has not only survived, it has matured into a sophisticated financial super app that is now aggressively stealing market share from legacy institutions. The gap between the expectation of a dying fad and the reality of a dominant fintech powerhouse is where the alpha lies, and it is exactly why the stock is trading at these elevated levels today. This massive 10% surge we just witnessed is largely attributed to the company's aggressive expansion into prediction markets and its newfound status as an S&P 500 component, a milestone that forces passive index funds to acquire shares regardless of price sensitivity. But to understand why this matters, we have to look beyond the headlines. The company recently announced a joint venture to launch a futures and derivatives exchange, aiming to capture the exploding demand for event contracts, betting on outcomes like election results or economic data releases. This moves Robinhood into direct competition with specialized platforms, but with the advantage of having millions of funded accounts already on the platform. When you combine this with the broader crypto rally, where Bitcoin has been trading above $89,000, you have a perfect storm of transactional revenue growth that the market was previously underestimating. Let's scrutinize the volume. Trading volume for the session reached over 46 million shares, significantly higher than its average daily volume of around 32 million. This indicates that this move is not a retail-driven fluke, but is backed by heavy institutional accumulation. When you see volume swell by nearly 50% on a breakout day, it signals that large asset managers are likely reallocating capital into the stock, chasing the momentum generated by the company's improving earnings profile. Speaking of earnings, the company's Q3 2025 financial results laid the groundwork for this rally. With net deposits reaching $68 billion over the last 12 months and Gold subscribers surpassing 2 million, the business is no longer reliant solely on transaction fees. They have successfully pivoted to a model that generates substantial net interest revenue, similar to how a traditional bank operates, but with a fraction of the overhead costs. Comment below how many shares of Robinhood you currently hold, or if you are still sitting on the sidelines waiting for a pullback. It is fascinating to see how retail sentiment shifts when a stock breaks through triple digits. The narrative here is about the great wealth transfer and how Robinhood is positioning itself to catch it. While older generations might stick with a traditional Fidelity brokerage account or use Schwab Intelligent Portfolios for their retirement planning, the younger demographic, which is now entering its prime earning years, is sticky to the Robinhood ecosystem. The company has brilliantly used its Gold subscription to lock these users in. By offering 3% matches on IRA contributions and high yields on uninvested cash, they have effectively created a moat that prevents users from leaving for SoFi Invest or Interactive Brokers. This is the Apple stock effect of fintech. Once you are in the ecosystem with the credit card, the retirement account, and the crypto wallet, the switching costs become psychological barriers that keep you there. We must also analyze the competitive landscape, because that is where the real battle is being fought. For years, the assumption was that as investors matured, they would graduate from Robinhood to a serious broker like Interactive Brokers, or utilize the advisory services of Fidelity Wealth Management. The reality is that Robinhood is growing up with its users. The platform now offers advanced charting, 24-hour trading on individual stocks like Tesla stock and Nvidia stock, and index options that appeal to sophisticated traders. By adding futures and prediction markets, they are effectively telling their user base that there is no need to ever open an account elsewhere. This consolidation of services is dangerous for competitors who rely on fragmented user bases. SoFi stocks and SoFi ETFs are trying to compete for this same demographic, but Robinhood's first-mover advantage in the user experience department remains a formidable hurdle. A critical component of this bullish thesis is the macroeconomic environment. We are operating in a timeline where interest rates have stabilized and the appetite for risk assets has returned. In this environment, Robinhood acts as a high-beta play on the entire market. When the S&P 500 rises, Robinhood tends to rise faster because its revenue is tied to the velocity of capital. More optimism leads to more trading, more margin use, and more crypto speculation. The recent surge in crypto assets is particularly potent for Hood. Unlike Coinbase, which is purely a crypto exchange, or traditional brokers that offer limited crypto access through ETFs, Robinhood offers a hybrid model. Users can trade spot Bitcoin and Ethereum while simultaneously managing a portfolio of dividend aristocrats. This duality allows them to capture revenue from both the degenerate speculator and the prudent long-term investor. Let's take a closer look at the prediction market news that acted as the primary catalyst for this week's move. By acquiring a stake in MIXDX and partnering with market makers, Robinhood is effectively legitimizing a sector that was previously relegated to niche platforms. Prediction markets allow users to trade on the outcome of future events, everything from will the Fed cut rates in December to who will win the next election. This is a massive, untapped asset class in the regulated U.S. market. If Robinhood can become the primary venue for this type of trading, the revenue potential is staggering. It differentiates them from Schwab and Fidelity, who are unlikely to touch such volatile products due to their conservative brand images. This willingness to push regulatory boundaries while maintaining compliance is what gives Robinhood its edge. However, we must also examine the risks, as no analysis is complete without looking at the downside. The stock is now trading at a premium valuation. A price-to-earnings ratio in the 70s implies that the market is pricing in flawless execution for the next 5 years. Any slip-up in earnings, any regulatory crackdown from the SEC, or a sudden cooling of the crypto winter could send the stock tumbling back down to earth. We saw this in 2022 when the market turned and Hood lost a significant portion of its value. The difference now is the balance sheet. With billions in corporate cash and a profitable operating model, the floor is much higher than it was 3 years ago. Yet the risk remains that a broader recession could curb the retail trading appetite that fuels their transaction-based revenue. Another fascinating angle is the credit card strategy. The Robinhood Gold Card, which offers 3% cash back across the board, is a loss leader designed to siphon deposits from traditional banks like Chase or Citibank. It is a bold move. By incentivizing users to deposit their paychecks into Robinhood to pay off their credit card, they are effectively becoming the primary bank account for their users. This increases assets under custody, or AUC, which is the holy grail metric for any brokerage. As AUC swells, the company earns more on interest and securities lending. It is a virtuous cycle. More features lead to more deposits, which leads to more revenue, which funds more features. Let's pause and consider the institutional perspective again. Why would a fund manager at a massive firm buy Hood at $128? The answer lies in growth scarcity. There are very few financials growing revenue at 20 to 30% year over year. Traditional banks are growing at single digits. To get growth, managers usually have to buy tech stocks. Robinhood offers a rare hybrid: financial sector durability with technology sector growth rates. This makes it a unique portfolio diversifier. It's not quite a bank, not quite a tech company, but something in between that commands a unique multiple. The technical setup on the chart tells a compelling story. The stock has broken out of a multi-year base. For technical analysts, this cup and handle breakout on the monthly time frame suggests that the stock could revisit its all-time highs from the IPO days if momentum sustains. The $100 level, which was a significant psychological resistance, has now flipped into support. As long as the stock holds above this level, the trend remains firmly bullish. The Relative Strength Index, or RSI, is getting overbought